Hello guys and welcome back. This is Billy FS, and in this video I'm going to show you how to align yourself most of the time with the correct direction of the market, and also how to enter the trade when you have your bias, right? Where you should enter your trade and when you should enter your trade. So in this video you're going to look at two things. The first thing that you're going to look at is the dollar index. The second thing is psychological levels. Don't forget to like and subscribe to help us grow the channel. And if you have any questions at the end of this video, you can leave it in the comment section and I will attend to you. So without much ado, let's get into it. Now the first thing, the dollar index. Now if you check gold, you can see that gold is paired with the US dollar, right? So this is very common. Everybody knows that, but they don't actually utilize that to their advantage. This simply means that if gold is rising, it means the US dollar is weak. And if gold is dropping, it means the US dollar is what? Strong. So why don't we look at the US dollar and look at when it is weak so that we can buy gold, and when it is strong so that you can what? Sell gold. So let's say that gold is giving you some kind of what? Some kind of sell signal, but the US dollar is giving you some kind of sell signal also. Then there's a conflict of interest because we want one to be weak so that you can what? We can buy the other, right? So let's just get into it and let's see how we can apply this to our advantage. Now I have the chart over here. Let me just remove this. Now this is gold and the daily time frame. I want to jump to the 1 hour time frame to get a little bit of intraday price action so that you can utilize that to our advantage. Okay. Now this area was a consolidation. That was yesterday, Friday. This is a consolidation. Okay. Now we had the market made a very bullish leg over here. We shall analyze this zone sitting right here, and we are going to see the reason why this supply sitting right here failed and why the market moved out from here. But for the meantime, let's start from here and analyze um from there. Okay. So if you understand market structure and how to actually mark up your chart, you understand that okay, we broke this level that is sitting right here. You can see we broke this level, and this is 2D. We broke the level. Let me just okay, I think this okay. We broke the level setting right here. Then we left an area of demand where the market can visit before we actually what rise again. So this is two areas that are interesting. The first area is the high that was broken over here because we can retest it and continue to move up. The second area is the demand that we are left over here because you can actually come to the demand and what buy back. Right. So scenario one was this: when gold was around this area, this is what could have happened, right? Can buy up from here. Scenario two was something like this. We can come down from here and visit the demand zone that has been left below so that the market is going to what? Buy, right? So this is what we have on what? On gold, or we had on gold. So how could we have used the dollar index to frame or to help us to understand the possible direction that gold is going to what? Move through, all right? So let's visit the dollar index and let's see something. We have to look at the time so that you don't get lost when you go to the dollar index, okay? So around this time was 6th May. Let me just adjust this thing. Around this time was 6th May, right? When gold was visiting the first area of what interest, where we expected the market to at least what rise. This was the first area of interest, and that was around 6th May, right? Wednesday, 6th May. Now let's look at the dollar index. We are expecting to buy from this area because this is an area where the market can retrace to and buy. So we are expecting to buy from this area. So if you want to buy, then what do? We expect the dollar index to be what? To be weak, right? If gold wants to rise, then the dollar index must be weak. If gold wants to sell, then the dollar index must be what? Must be strong. Okay. If one wants to sell, let's say gold wants to sell and the dollar index is also weak, or is like it also wants to sell, then there's a conflict of interest and you should stay out of those kind of trades as you are going to be stopped out most of the time. Okay. So let's look at the dollar index. So the dollar index around 6th May, that was Wednesday, based on gold. 6th May, Wednesday, that was around this area. Let me put a vertical line there. 6th May, Wednesday. Now, if you look at the dollar index, you can see that we are already what? We are already dumping, right? So the dollar index is extremely weak. Look at the market structure that the dollar index was forming, right? It made a high, made a low, made a high, made a low, high, low, high, then it failed. right? Made a pullback, then it's already dropping. So it means that our bias of wanting to buy gold is what is solid, is correct, because the dollar index is weak. So since the dollar is weak and gold is paired with the US dollar, please pay attention. Since the dollar index is weak, you can see gold spot US dollar. Since dollar is weak and gold is paired with the dollar, it means that at least we can expect the gold to what? Rise. Or you can expect gold to what? Rise. So it means that this area that we have marked is what? Is valid. And we can anticipate a reaction there to the top side. I hope you understand it. This is very simple. Don't complicate it. Just look at the two pairs at the same time and validate your bias when one is strong and the other is what? Weak. If both of them are weak or both of them are strong at the same time, it means that there's a conflict of interest and you don't want to do anything. Okay? You don't do anything. So it means that you could have taken a buy from here, not anticipating the market to what come down all the way to this what zone before you get some kind of what buy. Because the dollar index was already weak and gold was already at an area of what interest. This was a resistance which was broken, so it becomes a support. So this is a clear case of support and resistance or break or retest. So we can ride the trend what up. I hope this is simple, nothing complicated. Okay. All right. So let's look at another example over here. All right. I want to remove this thing. Let's look at another example over here. Now, this one caught me off guard because I didn't look at the dollar index. I actually took a stop loss around this area. I was trying to short the market because, of course, the market was already bearish. Look at how we came up. We came down from this top over here to this low. So I anticipated that the market is going to what? Drop. Okay, so there was a supply over here, which I believe was going to hold. Okay, so the market came to the supply and made a little bit of a reaction. Then I shorted the market around this area that is sitting right, forgotten about the dollar index, right? So let's look at the time, 5th May, Tuesday. That was when that was happening. Let's look at 5th May, Tuesday. 5th May, Tuesday. So around this area, the drop of the dollar index started around this area. So you can see that the dollar index is struggling to go up and it is what? It is trying to shift to the downside, right? Like we did, it is trying to shift to the downside over here, right? So that tells me that since the dollar is weak, gold might rise. So that alone should have told me that I should be careful at this area of what? Of this at this area of supply. I should be extremely careful. But I wasn't. I tried taking the sell, ignoring the signs that the dollar index was giving me, and I took a stop loss. And in Asian session, the market just what rallied up. So if I had just paid attention to the dollar index, just leave a limit order at this what at this level of demand that is sitting right here. Wait for the market to tap it and you ride all this move that is sitting right there. Just by looking at the dollar index, whether it is weak or strong, to validate or invalidate the bias that you are trying to build for the pair that you are trading. Okay, very simple, very mechanical, nothing too complicated. Now let's look at another example over here, and this is going to be the last example. Let's look at this example. This area over here was 1st May, was a Friday. The market came here, faced resistance over here and started what? Dropping. So since gold was weak at this point, we expected the dollar index to be what? To be strong. Okay, since gold is weak and I want to sell the market, I anticipate that the dollar index might be trying to make a reaction to what? Go up. So this is 1st May, Friday. So let's look at the dollar index for 1st May, Friday. 1st May, 1st May, 1st May. You can see this was 1st May. Started around somewhere here, right? So you can see that the dollar index actually started what? Started moving down first. So at this point, it's a conflict of interest, right? The beginning of the day, it started moving what? Down. So since you want to sell gold and the dollar index is also moving down, there's a conflict of interest. So you don't do anything at this point. You don't do anything. There's a conflict of interest, so you stay out of the market, okay? But coming into 3 o'clock at the same 1st May, you see that the dollar index started becoming bullish and it broke above this high that has been made over here. So this, the SMC people will call the change of character. So this means that since the dollar index is about to become bullish now, gold might be bearish. Okay, gold might be ready to be what? Bearish. Because the dollar index is about to become strong, gold might be what? Might be bearish. So it tells you that if gold is behaving bearish over here, then it is true because the dollar is becoming what? Strong. So gold must at least fall a little bit. Okay, so that was around 3 o'clock. So check the time. This is 4 o'clock. This is 3 o'clock. So exactly after 3 o'clock, the next candle that came, which was the 4 o'clock candle, started becoming what? Bearish. So at this point, if you were looking at the dollar index, you should have just what? Shorted the market after a little bit of what? Confirmation, then rode all this trend from here what to this draw on liquidity or this draw on liquidity or this draw on liquidity on this one that is sitting right here, which are giving you a very good risk reward ratio. Have you seen? We are just looking at the dollar index. We've not even applied psychological levels, and we are what? We are already at the right side of the market most of the time. We haven't even looked at daily bias, nothing, just the dollar index and just market structure, and we are able to what predict the direction of the market or align ourselves with the trend of the market most of the time. Very simple, very mechanical, very easy. Now let's look at psychological levels. Psychological levels. That comes in handy if you want to buy or you want to sell and you don't know where you should buy or where you should sell. Now, let me give you a rule of thumb. If you want to buy, buy from a demand zone. If you want to sell, sell from a demand zone. Sometimes the market can sell from a supply zone, sorry. But sometimes the market can, buy from a support level directly without getting into a demand zone. That is fine. If that causes you to miss an entry, then that is fine. You don't have to FOMO in. That trade is not for you. It's for the people who trade support and resistance. But if you trade supply and demand, then you should be able to what? You should be able to, deal with it and wait for the price to come into a demand or a supply before you can take your buy or your sell respectively. Now let's look at the psychological levels. Psychological levels are just round numbers, which acts as dynamic areas of support and resistance because institutions prefer to take trades around those areas, right? They don't want to be looking at a price level like, maybe 3, 4, 5, or 6 before they take the entry, right? They want to be looking at something like this, 3300, because that is easier for them to actually what take the trade. They want to be looking at maybe 300. They want to be looking at maybe 3450, right? So psychological levels are most of the time round numbers. Okay, most of the time they are what? Round numbers. So this is very important. You can see this to the nearest tens if you did a little bit of elementary mathematics. Most of the time they are round numbers. So it can be to the nearest hundreds too. Can be to the nearest hundreds. This can be 0. Okay. And of course, this is going to be 5 if you want to send it to the nearest, but that's not what you're doing. So you have to understand that psychological levels are just what? Round numbers. Okay. Now, let's look at some examples, 3 of them, then we can what? Can call it a video. So I have an indicator over here that helps me to mark my psychological levels, but you can actually what? You can actually look at the lines and what? The price levels and actually mark it by yourself. It is not something that is difficult. Okay. This is the code of the indicator. If you just need it, tell me and I'll send it to you maybe on Telegram or something, right? I think it's not opening. I'm good. It open. Okay. It is slow, so let's just look at what we are supposed to look at. My psychological levels are just taking the current price action, so we are just going to use our visuals to be able to determine the psychological that is occurring around here. But like I said, since the dollar index at this point was weak, we expected gold to at least what? Buy. This is where I took the stop loss I should have bought, right? So where is the area of demand where we can buy from? This is the area of demand, very simple. Where is the psychological level within the area of demand? Like I said, psychological levels are round numbers. So we start from the tip of the demand, then you see, is there a round number? There's 60, right? Can you see? Right? At the tip of the demand, you can see a price level that is 4,560.344, right? So because that is a round number, it's a psychological level. So you can put your limit order there and wait for the market to tap it and you move along with them. Or if you think that the risk reward ratio does not favor you, you can move it a little bit what? Below, like this. The next psychological level is what? 50. You can see the price also came to the 50 what? 50 portion, tapped into the zone and started what? Moving up. So you could have just placed the limit order at the 50 level or the 60 level, and you would have been in the trade and rode all the move that went up from here, maybe to 1 is to 5. I like 1 is to 5, so maybe to the next drawn liquidity around this area, right? Okay, right? Very easy, very mechanical, nothing to complicate. Okay, all right. Let's look at the next example. Let us look at the next example. Let's look at the next example. So this one is very, very simple. You can look at it and just tell that this was a demand. You can look at this demand that is sitting right there. Within this demand, where's the psychological levels that you can what we can look at? We have a psychological level around here. It is a little bit faded. Let me increase the stability. Supposed to show the visibility is supposed to show, but don't worry. So you can see we have a psychological level sitting right here. This area, you can see some thin dotted line around this area. Look at fine. Okay, so you can see now it is a little bit visible. You can see the solid lines. This is the first psychological level, but it's outside the demand that you want to what to deal with. You will leave it. The second psychological level is the blue line that is sitting right here, and it is aligned perfectly with the demand. So this is where you can what align yourself for a buy around this zone that is sitting right here. Then you take the buy to the what to the next blue line or the next area of what supply that is around this area. Taking an easy one is to what one is to save from this trade. And trust me, I took this trade that is sitting right here. This is not a bar for a lap. Okay. And that's that. I believe that is what we actually need to know. Let's look at the last example and we call it a video. Let's look at the last example. This area that is sitting right here. You can see how the market reacted exactly at this psychological level with the blue line, even went up and reacted to the what? To the next one above the blue line. So those are where the market most of the time what reacts. Okay, it reacts most of the time. And that's what at that point. And see around this area we have a psychological level over here. The market what reacted perfectly to the psychological level. So if you wanted to let's say take a short over here, go to the let's say 30 minutes time frame, you mark your area of supply. You can see a clear area of supply sitting right here. A psychological level within the area of supply or that touches the area of supply. You can see the first one sitting right here, right? Aligned perfectly with the area of supply. That is the 4630. So you can take a shot from there. But if you feel the risk reward ratio does not favor you, and look at the next psychological level that is around this zone, right? At the top of the supply, which you might not get tapped, or there's another psychological level at the midpoint of the what? The two psychological level. That is for precision. It's not most of the time used by me, but sometimes it gives what great interest to. So let's say you didn't see that one, but you use the first psychological level that is aligned perfectly with the area of what to supply. So we take a shot from here. Our stop loss goes above the what the area of the supply that we are dealing with, and we target the what the nearest drawn liquidity. In this case, it was what it was a demand that was sitting right here because the market was already bullish. So this was what a demand. We come to the demand, and that's what 1:5 risk reward. Trust me, what I've given you is a banger. Because I'm not maybe gatekeeping, you might think that this information that I'm giving you is just shallow or something like that sort. I had to sit down and master whatever that I'm trying to show you. Okay. So please take your time, go to the chat, look at my examples, and you're going to be fine with it. I had to pray and fast and tell God to show me and direct me towards the right knowledge. And these were hunches, things that the Holy Spirit told me to actually what to look out for. I did, and they were a game changer in my trading what journey. So please pay attention to them, learn them, and they are going to also help you in your own trading what journey. Thank you very much for watching this video. And once again, don't forget to like and subscribe if you like the video for more content, and also help us grow the channel. And if you have any questions, very important, leave them in the comment section and I'll come and reply you. Thank you very much for watching to the end. Billy FS out.